So we're going to meet with Daniel Lacalle. He's a chief economist at Tressis, based in Madrid and here in London. We're hoping to hear from him about Europe, the European project, European growth, how the interplay is working. Also dig a little bit into Spain, and he's just written a book about how we get out of this central bank trap. So hopefully we'll dig into that and hear his views on the commodity supercycle, where he's pretty bearish. Daniel, thanks for joining us at Real Vision.
Thank you so much.
Let's start on Europe. Bigger picture, growth is returning modestly. We have a decline in nationalist politics. For how long? Question. How do you navigate that? What do you think with the European project? Where are we in big picture terms?
In big picture terms, I think that what we can say is that every political catalyst that we have seen in the past 3 years in particular has been a little step further in cementing the strength of the European project. So even Brexit, the French elections, the German elections, the Dutch elections have proven that there is a much more solid foundation to the European project than what many feared. And I think that that is a positive. However, the challenges of the European Union remain. It is a monetary union, but fiscally it remains in shambles. And the problem that we're seeing right now is that now that growth is returning very modestly, as you very well mentioned, one thing that we can see right now is that the dangers of falling into the trap of the most dangerous words in economy, which are to incentivize internal demand, can come back. Because the problem of the European Union has never been one of lack of demand policies, rather the opposite. The European Union increased money supply, credit, and massive industrial projects throughout from the beginning until 2008, 2009, and then it exploded. And when the crisis exploded, the European Union decided to take again very aggressive demand side policies. It actually spent about 3.8% of its GDP in counter-cyclical measures, which ended up creating a bigger hole for the economies. The risk right now is actually that in order to try to keep calm the nationalistic parties, governments decide to fall again into the same trap, to try to repeat the same mistakes of big industrial projects, large infrastructure stimulus, big deficit spending projects as well, and therefore go back to a risk of entering into another stagnation cycle.
So you've written a book about this, how to escape from this trap. Share with us some insights. What are the key things that the policymakers should be doing?
Yeah, I think that in escape from the central bank trap, one of the things that I mentioned is that we cannot say, look, what central banks need to do is to disappear. Okay, we need to be aware that central banks are going to continue to be there. Now, what we need to do is to pay attention to the fact that large monetary stimulus, lowering interest rates, increasing money supply, the level at which we're doing, we are in a period in which, with no crisis, with no recession, the major central banks are increasing money supply, are buying assets by more than 200 billion a month, which is absolutely crazy. So one of the things that we need to do is to pay attention to what they're doing and to avoid the central bank from becoming what I call it in the book, the pyromaniac firefighter. The pyromaniac firefighter is the one that creates all the elements of a crisis, of a financial crisis, by massively lowering interest rates and increasing money supply, therefore leading investors and market participants to take massive risk for very low yields. Then when it all explodes, presents itself as the savior by doing exactly the same, by printing more money and lowering interest rates. So there are solutions. There are solutions in which we can find a way for the central banks to avoid considering the market exuberance and the excessive valuations of both stock markets and bond markets as a collateral damage that they shouldn't care about, because what they care about is core inflation and prices. They need to pay attention to that, and the way to do it is by having limits to monetary policy, by placing limits to monetary policy so that central banks don't place themselves constantly behind the curve, by at the same time paying attention to the inflation that is being created, because they talk about very low inflation, therefore no risk. However, we have massive inflation in financial assets. And that's the problem. So what they need to do is to normalize monetary policy more quickly than what usually, the defenders of demand-side policies say, but at the same time pay a lot more attention to risks in the financial market.
And how do they normalize that, given where we are in valuations, both with equities, fixed income, other asset classes? How do they normalize that quickly without creating a problem in financial markets?
Exactly. But the first thing, there's three ways, no? First, communication is very important. I think it was Ben Bernanke that used to say that communication is as important, if not more, than policy. So they need to be constantly reminding markets that easing is not perennial and that the policies will stop at a certain point and do it. Because the problem with the current policy is that they say, look, when employment goes down to 5%, we will normalize. Then they don't normalize when unemployment goes down to 5%. Therefore, the mentality of most market participants is the worse the better. So, which is a very risky one, which means that the worse that the economic data is, the better for financial assets, because we expect that normalization will not happen, because we expect that easing will continue. That perverse incentive can be very quickly stopped. First, with communication. Second, by having very clear Taylor rule measures that put the limits on monetary policy once the data, both on core inflation, on unemployment, and other of the elements that policy is set for, are reached. And by that, you avoid the trap of constantly becoming dovish, then a little bit hawkish, then a little bit more dovish, which is fueling much higher risk taking.
And how does this play into currencies then? Because I know you're a bull of the dollar versus euro. Is that because the US tapers more quickly, it goes first, interest rate differentials, or is it something else? You worried about the euro in particular?
I think that to believe that the euro will continue to be a strong currency, you need to believe first that the fiscal imbalances of the European Union are going to be sorted out. Politically, and knowing the history of Europe, not before the European Union even, it is very difficult to believe. So that's a part that is very important. But the euro will exist. Now the problem is it a currency that is a reserve of value for the world? And that is where the picture starts to crack if you want to be bullish on the euro relative to the dollar. Because no matter how you look at it, even if you look at data from the Bank of International Settlement, if you look at data of use of a currency, the reality is that the utilization of the euro as a currency globally is actually not increasing, while the use of the dollar is increasing. So if you have demand of dollars going up, while supply of dollars is not increasing because the Federal Reserve is tapering, is reducing its pace of easing and is increasing rates, etc. So demand for dollars is going up, supply is not growing radically. That defends the US dollar as a world reserve currency, reserve of value. That is the opposite with the euro. With the euro, what you have is the central bank of Europe, the European Central Bank, increasing supply of euros, while demand for euros is reduced even further if you look outside of the Eurozone, because the Eurozone obviously trades a lot within itself. And when the European Union talks about exports, they talk a lot about exports within themselves. It's like talking today, would be like talking like exports from, I don't know, Illinois to Michigan. So one of the things that I think is dangerous about being bullish on the euro versus the dollar is precisely that: is demand versus supply. The other one is that the European Union depends more and more on its trade surplus to continue to strengthen. That trade surplus cannot continue to happen with a euro that gets stronger and stronger, because the competitiveness of the European Union is not that high. It doesn't have large technological giants like the US. It doesn't have, high added value companies. It has predominantly mid-value, large conglomerates, which are fine, but these are not, let's say, cutting edge technology type of companies. So what it needs to a certain extent, a weak currency. The US, on the opposite, is becoming more and more, I wouldn't say isolated, but more regionalized as an economy. The US exports very little, about 13% of its GDP. On top of it, the US is becoming independent in energy, which is a very, very important factor. Therefore, for the US economy and for the government should actually defend sound money and a strong currency, because that benefits its citizens more. It does not need to devalue to compete in the global market, because it has massive technology giants, because it has high added value companies, and because the multinationals that export actually do not need a weak currency. That is not the case with the euro. Therefore, I believe that as the world becomes less incentivized by demand-side policies and by currency wars, the true value of the dollar relative to the euro starts to emerge back.
How are you navigating this in terms of investing? Where are you? What processes, methods are you using to try and find value, or are you seeing most things on the short side? How do you navigate all of this?
I think that for investors, the best way is to understand that easing policies exist. So we need to be aware that we're buying expensive assets. Now, what we need to understand is, within expensive, what is an attractive opportunity. Because at the end of the day, if the lowest risk asset is giving negative yields, the German bond goes to 10, 20 years before you even start to get any real yield. So you need to understand that you're going to be taking a little bit more risk with a little bit less return.